Good morning, everyone, and thank you very much for dialing in to our first Market Pulse webinar of 2025. My name is Natasha Lee Johnson, Strategic Account Director at Equifax, and I'm absolutely delighted to be your host for today. For those of you who might be new here, Market Pulse is a regular series which draws upon Equifax's big data and analytics capabilities to deliver a range of trends, visualizations, and insights to empower organizations like your own to navigate a complex and ever-evolving landscape. Now, interestingly, today, 26th of March, actually marks exactly 5 years since we officially entered our first legal lockdown. We'd seen the Prime Minister's broadcast ordering that we must stay at home, and many of us perhaps experienced feelings of uncertainty quite like never before. Worries about job security, finances, and even whether or not our loved ones would be safe and well. It was a very strange time to be living in. And whilst in many ways the pandemic now feels like a distant memory, its impact can still be felt today. And we've since seen major events that have since occurred, such as Brexit, the war in Ukraine, the conflict in the Middle East, all of which have had their own unique role in playing or shaping the economic landscape that we now find ourselves navigating. Inflation, increasing energy costs, higher interest rates, and an ongoing cost of living crisis are just a few of the challenges that we continue to face today. So during today's session, we'll be casting a light on how consumers have responded to the cost of living crisis so far. We'll analyse the impact on borrowing and arrears rates for you, the lenders. And Oxford Economics will offer their expert insights on the UK economic outlook for the year ahead. So without further ado, I'm pleased to welcome our guest speakers, Andrew Goodwin, Chief UK Economist of Oxford Economics. Hi, Andrew.
Hi there.
And hello, and Martin Smith, Head of Consulting of Equifax. Hi, Martin.
Oh, hi there.
So just before we get stuck in, I would like to cover some general housekeeping. We have a Q&A function just towards the bottom of your screen somewhere here. The webinar is being recorded, so if you have any technical issues, please don't worry. We will be sending a recording out later this week. And we will be answering all questions or trying to answer all questions during this series. But if we run out of time, we will also be coming back to you offline. So Martin, to start us off, are you able to give us a bit of a view of what we're seeing from a bureau perspective, please?
Yeah, thanks, Tash. Before I go into the bureau view, I thought it worth just kind of recapping on what we were seeing kind of last year. So if you think back to when we last did one of our kind of Market Pulse sessions, which was about 18 months ago, consumers were being kind of hit by a kind of cost of living crisis, as we know. So inflation was starting to level off at that stage, but prices were still rising faster than wages were. At the same time, we were being hit by interest rate rises for the first time in a long while. So those rates hit kind of historical highs, and then that was sort of following the kind of market turmoil. At the same time, or really following the kind of interest rate rises, I guess, consumers were being hit by mortgage shock. So consumers found themselves, when they were moving from low rate fixed or tracker mortgages, or even just kind of experiencing rises in the kind of standard variable rates, they found themselves moving from historically low rates to very high rates, which had an impact on mortgage repayments. And that's still washing through today. So lots of those consumers who are on kind of 5-year fixes are still sort of seeing some of those impacts as they sort of try and navigate the mortgage market. And then finally, the sort of utility price rises that we were seeing, obviously those kind of rises in kind of fuel caps and so on have continued. And so they've continued to have an impact over the last sort of 12 months or so. So that kind of raises the question, where we are today, and I'm going to look at this through the lens of sort of both insight data, so some of our kind of shared financial services data, and also transactional data that we have access to here at Equifax. So I guess the first theme is around the kind of fairly slow recovery of the mortgage market since 2023. And what we've seen is that sort of, although in 2023 we saw a kind of 29% sort of drop off in mortgage originations, and consumers were really trying to find their way in terms of, are these rate rises permanent? Are they a permanent feature? Are they going to level off? Are they going to continue to rise? And so there was a bit of a reluctance for people to make sort of huge sort of mortgage related decisions. But obviously that stabilized a little bit. And during 2024, we saw a fairly slow recovery. So 4.1% improvement or increase rather in mortgage originations during that year. So that leaves us sort of 24% lower than before the kind of interest rate increase cycle. A consequence of that, obviously, is that mortgage repayments remain high. So overall, the average mortgage repayment is £221 a month higher than it was in 2022. And for new mortgages, that lending is 58% higher than it was before the kind of Liz Truss budget, when all these kind of rises started to kick in. Now, that's kind of an obvious consequence of there being rate rises that mortgages get more expensive. And what we're seeing, therefore, is that the average mortgages for new mortgage lending is just short of £1,000 per month, up from about £600 or so, or £700 a couple of years ago. So a consequence, so how do consumers kind of cope with higher mortgage repayment amounts? Well, one way they do that is that they're choosing to sort of extend their mortgage term for longer. So almost like mitigating those higher repayment amounts, we've taken a mortgage over a longer period of time. And so today, 30% of new mortgages have terms of 30 years or more. And what that means is that we're seeing a kind of rise of lending into retirement, which is not to say that borrowers are necessarily expecting to still have a mortgage in retirement, but it just means that the sort of ages at which the theoretical payoff date for the mortgage is routinely heading beyond 65 and sometimes 70 years. So that 30% figure, within that, we've got 10% of mortgages which are currently sort of for terms of 35 years or above. So it's really a story of consumers trying to reduce what they pay by extending the mortgage. So just quickly looking at arrears. So following those initial kind of interest rate hikes in 2022 and beyond, we started to see mortgage arrears increasing. And those arrears rates peaked during 2024 and have now started to fall again. We also see an improvement in arrears deterioration. So in other words, people who've gone from one payment down to two payments down, or from 2 to 3 and so on, those rates have also fallen in line with more general arrears rates. And I think what's maybe been happening is that consumers initially were kind of caught out by those kind of higher rates, particularly on standard variable rates, and have taken a while to adjust, and that's kind of started to stabilize in the market now. So it's a fair question to ask, where does that kind of arrears growth come from? And what's kind of interesting in light of what I said earlier about the sort of the rise in sort of mortgage term and lending into retirement, is that it's actually older borrowers who are kind of driving a lot of the growth in relative arrears. Now, that's not to say that arrears rates are particularly high for these groups, but in terms of where the biggest growth is coming from, it's in those kind of older age cohorts. So it's consumers who are age 56 and above who've had the highest relative rise in mortgage arrears in the last couple of years. Okay, so that's the sort of secured picture. Turning now to unsecured lending, we see again some changes there across a whole range of different products. So first of all, looking at credit cards, we see that acquisition is up and credit limit setting is up as well. So we saw an 18% growth in new credit card openings during 2024. And alongside that, there was a 17% increase in the number of credit limit increases as well. So it feels like that sector has kind of bounced back. What we saw during the pandemic was a big payoff in kind of credit card debt. And as consumers were obviously not spending quite as much, and that sort of has gone alongside building up savings that was happening at the same time. But actually what we're seeing now is that sort of the credit card debt is up 4.5% compared to pre-pandemic levels, and it's up 5.6% year on year to around about £71.2 billion. So this chart actually shows what looks like a very steady increase compared to the sort of benchmark at the beginning of sort of 2021. Actually, it follows a period where credit card debt was falling quite substantially. So although this looks like a sort of big increase, it's really just about sort of returning to where the market was and slightly beyond that at this point. So looking at retail finance, so this is kind of store cards and other point of sale type products. What we've seen over the last couple of years is retail finance becoming a slightly less prevalent choice. So we've seen a slight drop off in volumes compared to 2021. And although the volumes are reducing slightly, they're on a slightly downward trend, lenders are actually tending to offer bigger limits as part of that. And we think that what's happening here is that retailers are kind of under increasing pressure from retail finance companies rather are under increasing pressure from buy now, pay later, and retailers are diversifying what they offer at the point of sale. So at the point you're actually making a purchase, you've got your usual credit card offers there. You've got Apple Pay, which opens up whatever's in your wallet, but you've also got buy now, pay later being offered as a sort of as a kind of tempting offer alongside the retailer's traditional kind of finance offerings. So that's what we think is happening there. That's kind of challenging the retail finance sector and driving some innovation there in terms of things like embedded finance. So what's happening on buy now, pay later? Well, that continues to be a kind of popular choice of product for consumers. So now, again, looking at transactional data, we can see around 36% of consumers have used a buy now, pay later product in the last 2 years. And in any given month, around about 25% of consumers have that type of payment in their transaction record. So typical spend is around about £66. That's slightly up on 2023, and that's reflective of people who've got a number of kind of buy now, pay later, where they're splitting the debt rather than it being just a deferred one-off payment. So taking a look at some of the other products. So year-on-year arrears change, this slide. So back in 2023, we were seeing arrears increases on a number of products, so especially auto finance and unsecured loans. During 2024, a lot of those kind of products improved in terms of their arrears levels. Auto finance was still up a further 4.5% year on year, and that was driven mainly by the second-hand market. So the auto finance around kind of forecourt dealers and so on. And then looking at acquisition, so again in 2023 we'd seen sort of acquisition reducing year on year for most products, but in 2024 we did see some growth returning in acquisition. So credit cards, as I mentioned, but also in unsecured loans. Where we saw some further reductions was in mail order borrowing and also telco airtime providers as well. So telecommunications companies have largely split out the airtime and the handset lending aspects of their business, and consumers are really kind of taking to that. So they're not necessarily changing their airtime contracts as often, but they are still after the latest phone when it hits the market. And so that type of borrowing is up by around about 14% year on year. So that's the kind of unsecured world. I thought we'd now just do a quick look at how did consumers navigate the cost of living crisis. And what we're doing here is taking a look at some sort of a view of kind of income and expenditure. So if we think about the way that lenders often consider income and expenditure, we tend to look at 4 different areas. So the first of them is bureau data. So what's a consumer's fixed term credit commitments? What does their rent and mortgage and utility payments look like? And the second area is around income verification. So we can now show data from payroll systems, from HMRC data for taxation and income, and also current account turnover. And just as an aside, there have been some rule changes on current account turnover recently, which is opening up that more granular view of current account turnover data to a larger number of financial services companies. So if that is likely to affect you, then do give me a shout. We can have a discussion about how that might work. The third area is around self-declared information. So either declared information or data that's been shared through sources like open banking, and whether or not that's appropriate for a particular application type. It's usually the case that sort of declared information that you can test against another source is a kind of good way of trying to work out, can a consumer afford this lending. And so to help with that, we tend to use some kind of spending assumptions, and Office for National Statistics data, ONS data, tends to be the kind of primary route to doing that. So what we're seeing through our sort of analysis of transactional data is that this kind of modeled data or surveyed average expenditure from sources like ONS, it can misrepresent how real customers spend. Number of reasons for that. So inflation is experienced differently in different categories. So the way that you sort of experience inflation in the supermarket is different from if you're buying a car, where you're only affected by that at the point you make a purchase decision. Second thing is that consumers react differently to price rises according to income and other factors. So if they've got an ability to change what they spend and where they spend it, then they will tend to take that opportunity. And so what we think is that a more granular approach, where you sort of look at customer segmentation, you look at income bands, you look at postcode data as well, that can get you closer to the real picture in terms of what real consumers are doing. So what we've done for the next couple of slides is really take a look at transactional data, and we focused on grocery shopping as one example. And we've taken a look over a 2-year period and compared how the real sort of transactional data looks compared to what we see if we were just taking ONS and adding on an inflation figure. And then what we've done is compared that for different income groups as well. So the first one is showing grocery spend for the second lowest income decile. So in other words, the 10% of the second lowest 10% of consumers in terms of their income. And what we see for this group is that their expenditure on groceries went up sort of the same as inflation. So as soon as inflation started rising, the level of expenditure for this group went up exactly at the same rate. So ONS, and adding inflation to that, did a really good job of reflecting spend for this group. If we look at the middle income band, so the 5th decile, these consumers were able to constrain their spend. So they've sort of mitigated that rise in grocery prices by doing something different. And so for this group, ONS plus inflation, which is the dotted blue line that sort of rises as inflation rises, that sort of fails to pick up on a key behavioral change, which we can detect through transaction data. And really what that boils down to is consumers trading down their supermarket. So they're buying cheaper products, own brands, but they're also kind of shifting where they shop as well. And so share of wallet analysis helps us understand that move. And we can look at the kind of winners and losers of that based on a view of primary supermarket choice. So where does a consumer spend the most and where do they spend most often? And so again, this chart is just really showing that shift. So it's showing that since taking an average baseline from 2022 Q1, we see that there's a big shift towards budget supermarkets and away from the big 5 in convenience stores in the main. And that shift is around about 4% in terms of where someone's primary supermarket exists. Of course, consumers are not completely uniform. So, the fact that you've moved from Tesco to Lidl still means that you do some of your shopping in smaller places and one-off shops at Tesco. It doesn't, there's no sort of uniform shift in a particular direction, but it's just more in case of what does the transactional data show us about the shift in consumer behavior. And if we then look at a brand level, this is kind of the story really. So it's Lidl and Aldi who are the kind of big winners over this period, which has been well documented. The sort of mainstream losers are kind of Sainsbury's and Asda, with Waitrose losing out as well. And actually, I mentioned, consumers are not sort of completely uniform, and M&S Food has done a good job in sort of increasing its share of primary spend. Partly it's done that by having a really good kind of basics offer. So the price of milk in M&S is broadly the same as you would find in Aldi and Lidl and elsewhere. And they sort of focus on a few basics to get consumers in, and they've done a good job of bucking that particular trend. So I guess that's the sort of summary essentially, that using sort of transactional data can give you a kind of really accurate, really dynamic view of changing income and expenditure trends, not just in terms of where people spend and what they spend it on, but also in terms of income profiles and how that's changing over time as well. I mentioned we can segment this, so we can look at this through brand lenses, through age, income, and also kind of a postcode view of this. So you can sort of plug these insights into different sort of income and expenditure and affordability calculations. So that's it from me. I'm going to hand over now to Andrew, who's going to talk us through the economic picture.
All right, thanks, Martin. You've heard about the recent trends in consumer borrowing. I want to focus more on sort of how changes in the macroeconomic environment are likely to affect demand for credit moving forwards. I'm going to start by thinking about household spending power. Now, it sort of may go contrary to sort of popular belief and to sort of individual experience, but in aggregate, 2024 was actually quite a good year for the household sector. We had about 4% growth in incomes on an inflation-adjusted basis. But 2025 promises to be a much tougher year, and there's a number of reasons for that. The first is sort of on the inflation side, and certainly we're expecting inflation to pick up as we move through this year. Now, there's four sort of key reasons for this. The first one, I think, is one that's pretty well known and has been played out in the media, and that's that we have higher energy and sort of other regulated prices like water to come through. So obviously, big increase in the energy price cap in January, another one coming through that we know about in April. And obviously, a lot of water firms as well are increasing their rates, the cost of their water bills by more than sort of 20% from the start of April too. So we're expecting inflation rates to actually start to rise quite significantly from April and to then sort of grind upwards as we move through the rest of the year. Now, we've also had the impact of a weaker pound coming through. That's particularly since the US election result at the last part of last year. Now, some of that weakness has reversed in sort of recent months, but there tends to be a bit of a lag in the way this works through. And at the moment, we're seeing goods prices, particularly imported goods prices, obviously, start to pick up. We're also expecting some impact from two parts of government policy. One of them it sort of goes back to what Martin was talking about earlier, and the sort of segmentation of sort of different people. That one is the increase in or the imposition of VAT on private school fees. Now, obviously, that's something that probably only about 1 or 2% of people will actually endure or will have endured from the start of this year. But that is something that sort of affects inflation sort of more generally. Something that will sort of have a much wider effect, I think, is the upcoming increase in employers' national insurance contributions and the increase in the national living wage too. We'd certainly expect sort of firms to try and pass some of that cost on to consumers in the form of higher prices. And obviously in sort of the more labour-intensive parts of the economy, particularly the services sort of sectors, that could be quite significant. So we think inflation is going to go up from being around 2% last autumn to potentially almost 4% when we get to this autumn. But I suppose the good news on this is that a lot of these effects are temporary and should start to fade as we move through next year. And 2026 should look like a more normal year again. Now, if we move on to the next slide, the national insurance increase, I think, could have some quite bigger effects really sort of across the sort of consumer sphere. It's not just an inflation story. And that really sort of goes to how firms are telling us they're actually going to deal with the increase in national insurance contributions. As I sort of mentioned, part of the story will be that they'll try and increase their prices. Part of the story may also be that they try and sort of reduce their margins as well, or sort of endure some sort of margin compression. But we also think that this will actually impact on the labour market quite significantly as well. That's through both the idea that firms will probably increase wages by less than they would have done otherwise, and also by having either sort of headcount freezes or by sort of firms in some cases having to let go sort of workers in order to try and keep a lid on their pay bills. Now, this part, I think, is probably the most difficult part for an economist to actually sort of estimate. Our sort of starting point on this is to run a sort of scenario for our economic model. And that scenario sort of leaves us cautiously optimistic, I would say. It suggests the impact on employment and earnings should be quite small, adding about 0.2 percentage points to unemployment, knocking about 0.2% off of average earnings growth. But we're a little bit concerned that might underplay the potential impact, and that's really for three reasons. The first is that the nature of the increase in employers' national insurance contributions makes it much more costly to employ lower paid workers. workers. So essentially, it's not just the rate of contributions that are going up, it's that the point at which you start paying them is actually coming down quite significantly. Now, that factor and the fact that this is happening alongside a very large increase in the national living wage means that the cost of those lower paid workers is increasing significantly. The chart on the right there sort of gives a sort of view of how we think this might play out across the income distribution. And you can see that for somebody who's on the national living wage, they will cost their employer more than 10% more after April than they would have done last year. So quite a significant increase. Whereas if you go sort of up the income distribution, that decline sort of falls to about 7%, 7.5% for somebody on the 90th percentile. So this does really act as quite a regressive tax and does disincentivize firms to employ lower paid workers. So certainly sectors like retail, hospitality, who employ a lot of these workers, I think are going to be highly vulnerable here. And I think when you layer those factors onto the fact that company profit margins are already pretty weak, certainly as weak as they have been in the last 20 years, there is a real sort of question mark about the ability of firms to actually withstand those sort of cost pressures. So our view is that though our sort of scenarios suggest that the impact should be relatively benign, there is quite a significant risk that actually we have what economists would call non-linearities playing out, and actually you end up sort of effectively having this being the sort of the straw that breaks the camel's back, and you end up with much greater job losses. So I think the risks are certainly skewed towards employment taking a much bigger hit than our scenario suggests. If we move on to our sort of next chart, that then sort of gives you a sort of quite a good sort of demonstration of how these sort of various factors play out in terms of sort of income and inflation. Because of the hit to wage growth from the sort of the increase in national insurance contributions coming alongside the temporary pickup in inflation, we actually think that strong income growth picture that I spoke about at the start will gradually fade as we go through this year, and certainly by the time we get to the end of 2025, we're likely to be in a sort of situation where spending power is only increasing very slightly. Now, if we move on to the next slide, I want to sort of think about how this then sort of reflect or sort of plays out in terms of interest rates and sort of the impact on different sort of borrowing groups. I think at a top level, we expect the Bank of England to continue to cut interest rates over the course of the next sort of year and a half. Financial markets have become a little bit nervous recently. They're looking at sort of what the bank are sort of trying to do and trying to balance that sort of higher inflation story that I spoke about with lower economic growth and a softening labour market. And financial markets think that sort of the bank will come out more on the sort of inflation side and actually stop cutting interest rates much earlier than we do. We think actually what will probably happen is that the bank will actually take a more forward-looking approach, will continue to sort of cut by about 25 basis points a quarter, as it has done so far, and that the policy rate will eventually sort of head down into the threes and maybe sort of settle somewhere in the sort of 2.5% to 3% range in a couple of years' time. Now, that should be reasonably good sort of news for most borrowers, but I think sort of, again, harking back to this sort of story of segmentation, the experience of individual borrowers is going to be quite divergent here. And my next chart sort of really sort of shows that in terms of the impact on the mortgage market. So I think if you're on a standard variable rate mortgage, then obviously you should sort of benefit pretty quickly from those cuts to bank rate. You would already have seen your mortgage costs come down in the last sort of 9 months or so, and chances are that they will continue to gradually sort of fall as we move through the next 18 months or so. If you're on a 2-year fix, I think sort of you're in a reasonably similar boat. The picture for you will probably be quite volatile because it really depends on when you took your fix out. Obviously, if you sort of think back 2 years ago, there was quite a lot of volatility in the mortgage markets. We'd just come off the back of the sort of the trust premiership. We then had a sort of surprise increase in inflation, which then pushed up sort of money market rates and pushed mortgage rates up. So anyone who took the sort of their mortgage out at the height of that sort of crisis, could quite easily see their mortgage costs come down over the course of the next year or two. But even those who sort of didn't and who actually sort of benefited from one of the sort of the lower parts of those sort of waves, you're unlikely to see your borrowing cost increase. The big difference, I think, is and again, Martin sort of spoke about this earlier in terms of what's happened recently. It's those people that are on 5-year fixed rate mortgages. Those people that have refinanced recently obviously had increases of 250, 300 basis points compared to their previous fix. And we project that as we sort of move through the next couple of years and people continue to roll off those very cheap fixes, that the vast majority of those people will still see increases in their interest rates of 250 to 300 basis points. Really, that's likely to remain the picture all the way through 2025 and 2026. And it's only really when you get into sort of 2027 and beyond that you actually start to see the sort of the impacts start to stabilize. So there is a very, very long lag involved with those borrowers. Now, if we're sort of switching back to thinking about aggregates and how that affects the sort of wider economy, the big issue for the wider economy is that the vast majority of people are on 5-year fixed rate deals. So we are still sort of actually grinding upwards if we think about the sort of the average interest rate that sort of consumers are paying. But as I sort of suggested, the divergence across the sort of various parts of the economy is really going to be quite stark. Now, I wanted to finish by sort of thinking about how this all affects sort of borrowing going forwards and sort of what sort of lending levels that we can expect. And I want to start with the mortgage market. And obviously what sort of matters most for new mortgage demand is the level of sort of mortgage rates as they are today. Now, we are in a slightly better position today than we were a couple of years ago if we think about mortgage affordability. We've obviously had a period where house prices haven't really done a huge amount. They've been relatively flat. Pay growth has started to sort of, has obviously been quite strong. Mortgage rates have come down a little bit compared to where they were. So what that means is the sort of the very unaffordable situation that we had a couple of years ago is sort of gradually improving. Relative to historical averages, house prices are still quite high. But certainly relative to where we have been, the picture has actually improved quite a bit. So the underlying picture we expect to see is one of mortgage demand gradually strengthening as we move through the next couple of years. But I think it's important to say that in the near term, we do expect quite a bit of volatility because of the change in stamp duty thresholds that's due to happen at the end of next week. Obviously, we've been in a situation where for the last couple of years, stamp duty thresholds have been temporarily increased. They'll now go back to where they were. So effectively, the amount of stamp duty that people pay on a purchase will go up sort of from next week. So that is likely to have meant that there's been a sort of effectively a surge in demand ahead of that deadline, a surge in sort of people trying to get their mortgage approved and then sort of complete their transaction. And then there's likely to be some payback as we sort of move through the summer. So once that volatility has sort of washed through, we do expect the situation to improve. If we turn now to sort of unsecured lending, I think unsecured lending demand has been exceptionally strong over the last sort of few years. In part, that is just a high inflation story. Obviously, these figures are sort of reported in cash terms, so inflation's high, then you tend to get sort of high cash term spending. And to some extent, we expect that to sort of drag lending growth up in the very near term. But as that story then sort of fades as we move through next year, the sort of the softer income growth story starts to sort of take hold. Now, we do expect some mitigation from stronger consumer confidence. I think a big feature of the last sort of year or so is that even though at an aggregate level, household incomes have actually improved a fair bit, consumers have been quite reluctant to spend, and confidence has been quite soft. But there is sort of certainly evidence in some of the recent surveys that confidence is starting to firm, that people are feeling a little bit less sort of concerned about making major purchases. They're feeling it's less a sort of good time to save, I think, particularly given that interest rates are coming down. So we do expect that sort of situation to sort of mitigate the impact of weaker household income growth. So I think sort of, certainly on both sides, there are reasons for optimism, but certainly on the unsecured side, we don't expect to see the sort of the very strong growth of the past sort of 2 or 3 years to continue. I'll hand you back now to Natasha for questions.
Thanks, Andrew, and thanks, Martin. Some really interesting insights covered by both of you there. I think it's very promising to see some of the resilience that we've seen actually from consumers, particularly during a time where financial pressures are pretty tight at the moment. And it sounds, Andrew, like we're not quite out the woods yet on that. So a little way to go, but generally a lot of consumers have been quite resilient, turning to those measures such as, less brand loyalty when it comes to groceries, and also kind of flexing when it comes to mortgage terms. I think it's equally noteworthy, I guess, to highlight some of those higher risk categories where they've got less ability to flex. So the older borrowers who can't increase their mortgage terms, they've not got the ability to, and also those low income households, which it sounds like there's a bit of a twofold issue here, both with that less flexibility around being able to switch brands, but also with some of these upcoming changes, Andrew, that you've alluded to with national insurance and the flow down impact that could have on job losses. So we have got quite a lot of questions that have come through. So I am going to go through and see if we can start working on these. So to start off, for Martin, somebody has asked if we've shown the differences in grocery spend and how that differs for different income groups. Where else does transaction data work better than ONS?
Yeah, that's a good question. So I guess what I'd say is that if you're able to use transaction data to make individual decisions, that's always better than taking an average in general. If you're comparing a sort of transaction-based average to ONS, now there are some categories where we do see those kind of bigger differences. So groceries is the one that I've sort of highlighted for the presentation deck. Things like, I guess anywhere where you've got sort of discretionary spend, so things like takeaways, restaurant food, and so on. Those are the kind of things where consumers can kind of tighten their belts and almost in real time, you can see a difference in those averages coming through. If you were to be monitoring those. Equally, there are some categories where you don't really see much divergence from what ONS would tell you about. So if you think about something like gas and electricity, those domestic bills, there's not really much you can do other than turning your boiler off. There's not really a great deal you can do to avoid those charges and therefore get impacted by whatever inflation rates come along. So I'd say it's that. I'd say it's kind of more discretionary stuff, or stuff where you've got a choice about how you spend and where you spend it, is where we see the biggest divergence.
Excellent. Thanks, Martin. Andrew, we've had a question from somebody asking, what impact is global instability having on your forecasts? So, for example, the threat of tariffs from the US or the increase in defense spending as a result of the Ukraine war?
Well, I mean, I suppose it sort of has an effect in two ways. So I suppose just sort of uncertainty itself is pretty toxic, particularly for businesses. So, certainly our sort of forecasts for things like business investment have weakened quite a bit, just because businesses are telling us that they're worried about the world and they're sort of taking a much more cautious approach to spending. There's also a sort of practical or logistical sort of issue as well. Particularly if you sort of think about the experience of US tariffs, where we've had a couple of times where they've imposed them one day, then they've reversed them the next day. Then obviously trying to sort of forecast on a consistent basis is quite difficult. What we do is our baseline forecasts are essentially what we call a modal forecast, so our sort of view of what the most likely outcome is, rather than a sort of weighted average. But we're continually saying to our clients it's really important that people use scenarios as well, because the chances are one element or other of our modal forecast will be wrong, particularly given there's so many different sort of bits that are political and sort of trade related that are very hard to pin down. So actually sort of using scenarios to plan is really vital, particularly at this sort of time.
Yeah, thank you, Andrew. We've had another question from Zita McMillan. So how does the postcode level data level analysis help with the spending assumptions? I think that's one for Martin.
Yeah, so it can be used in a number of different ways. So if you think about the way that ONS is typically used at the moment in those kind of assumptions, you'd use it as a kind of almost like a backstop. You'd use it to sort of challenge whether or not a consumer's declared income or declared expenditure seems reasonable compared to what the national average would be. So you think about what ONS is, it's essentially a sort of surveyed approach. So the ONS will survey 12,000 households. They'll ask them what they spend in a whole bunch of categories. and then they sort of make that sort of robust, statistically robust for the whole country. I think where the transaction data is taking us in is into sort of looking at that sort of spend at a more granular level, and one of those levels could be a postcode view. So understanding that in a particular postcode there's a tendency for rental amounts to be higher than average, that will be an example. But it really just gives you a different view. It gives you a different view of what a consumer's expenditure level is likely to be. And in general, we'd recommend that more data is better than less. So using ONS, postcode data, or transactional data, and open banking, and all those other good sources is always a good way of getting a rounded view of the consumer.
Excellent, thank you, Martin. For Andrew. Is this for Andrew? Martin's slide showed the Equifax data that credit card debt going above pre-pandemic levels, as well as a significant use of deferred payment. What's your sense of how problematic UK consumer borrowing levels are at the moment?
So I think this is probably one where the aggregate picture and the sort of the more granular picture may differ. So I think obviously as an economist, we tend to look in aggregates, and in aggregate, the actual household picture looks reasonably good. There's been quite a lot of deleveraging since certainly since the financial crisis, and also to some extent since the start of the pandemic. So yeah, household balance sheets actually look in reasonably good shape. I think the issue is sort of when you break it down, who actually has these sort of these debts and sort of their ability to repay. And I suppose sort of thinking about deferred payments and the like, that's really an element that we don't have a huge amount of visibility on as sort of economists. We don't generally benefit from the sort of data that sort of Equifax and others do. So that is a bit of a blind spot, I think, for economists, and certainly one where there could be a ticking time bomb sort of there that we're not really sort of that well aware of.
Lovely, thank you, Andrew. For Martin, but also happy to get Andrew's perspective, I think, on this one. Do you feel the growth in buy now, pay later is a ticking time bomb from the perspective where consumers do not fully appreciate how it can impact your credit score, particularly in reference to things like late payments or small defaults?
Okay, so I think the thing to say about buy now, pay later is that it is an unregulated product, and I think we'd be very keen to see more regulation of buy now, pay later, and in particular, a greater degree of data sharing, so that kind of levels the playing field for all credit providers. I think if we look at the credit quality of buy now, pay later consumers, those customers who use those products, it's a very sort of diversified product in a way. There are kind of very wealthy, affluent consumers using that just to spread the cost of a larger purchase. But equally, at the other end of the scale, there are consumers with very low credit scores who are using it because they don't get credit from elsewhere. And so I'd say that I don't really view it as a ticking time bomb. I think it's kind of taking a lot of the or some traffic from other credit products. But I think there's always stuff that we could do better as an industry that would help customers who are kind of struggling with finances or having an impact on their credit score as a result of missed payments and so on. We can do a lot more to assist.
Yeah, I suppose there's the risk as well, with buy now, pay later, it could be like small amounts of payments, which actually on their own don't seem like a big amount to be taken on, but it's that accumulation potentially that consumers are kind of opening themselves up to, that they perhaps don't realise the value that it then amounts to.
Yeah, I agree. I think the thing that I see as problematic is where you see sort of payment mechanisms offering, buy now, pay later on a takeaway or on a grocery shop. These are things that traditionally we didn't really encourage consumers to sort of put on longer term credit. Okay, maybe you could use a credit card in that way, but I think there are sort of some concerns there. But broadly speaking, the way it's being used is fairly sort of it's being used broadly and fairly across the spectrum.
Yeah, excellent. So we've also got a question, I think, for Andrew. So this attendee agrees with your Bank of England rate forecast. When do you think your view becomes obvious to the market?
I'm glad to hear it. So I think I suppose there are two issues that I think markets are a little bit concerned about. I think one is that they see almost a sort of 100% read across from the US to the UK. So to some extent, their sort of more bearish forecast for the UK rates is just a reflection of the fact they expect US rates to remain very high, and therefore that will almost be sort of dragged along with the US. I think the other aspect is that sort of national insurance rise. I think there is a concern amongst markets that the next rise will actually be much more inflationary than we believe it will be. And I think, certainly the Bank of England themselves, sort of abstracting from all of the sort of noise around tariffs and the like, have actually identified the next rise as being really their sort of key uncertainty, particularly domestically. So I think once we get sort of some evidence about how that's actually playing out, which is probably going to come, I would say, mid to late summer, really sort of probably in time for the August MPC meeting, that's when you should get a much sort of firmer view, I think, of how that's playing out. And therefore, we think if we're right, that markets will then come back down to sort of meet our forecast around then.
Excellent. Thanks, Andrew. So I think we're going to wrap up here, guys. If there are any questions that we haven't answered, we will come back separately just to follow up on those. I think that concludes today's session. So thank you ever so much to everyone who has dialed in today. We really appreciate your attendance, and we hope that you found it useful. We will have a feedback form towards the end of the session. So once the video call has ended, a feedback form will be issued. So we would really appreciate any thoughts and feedback that you are able to share. Good, bad, ugly, we'd love to hear it. So there will be a further Market Pulse webinar series coming up. This will be, as I mentioned at the start of the call, a regular event. We will be issuing dates and times over the coming weeks. So please keep an eye out, and we'd love to see you at the next one. Thank you very much. Okay. Bye.